We are now going to bring in David, and I'll let you tell him about Octopus Renewables.
Thanks, James. And yeah, good morning, everybody. I will take you through the really interesting bits of the deck here. And yeah, for just an introduction for those who don't know who I am, my name's David Bird. I work for Octopus Energy Generation. We are the fund management business that sits within the Octopus Energy Group, and I'm one of the managers of Octopus Renewables Infrastructure Trust. We call that ORIT, so I'll use that shorthand for now. That's also the ticker. So ORIT launched now coming up 6 years ago, so in the latter part of 2019. And we launched with what we see as a key differentiator between us and the quite wide range of other renewables investment trusts that are out there in the market, and that is diversification. We see ourselves as the only genuinely diversified investment trust of meaningful scale in the space. And when we're talking about diversification, we're particularly focused on geographical diversification. So we have assets in 5 countries across Europe, and then also technological diversification, and with a particular focus on having both wind and solar generation assets alongside other complementary technologies. So over the past 5 and a bit years, we've built a portfolio of almost 800 megawatts of operating capacity across 40 different assets, including our developer stakes. But it's not just the diversification that we think sets ORIT apart from the peer group. We also have the benefit of access to the large team within Octopus Energy Generation, around 150 people, who are not just people with finance backgrounds, but include a lot of engineers, people from renewable energy, developers, wind turbine manufacturers. And that's really important when you look at the other key piece to ORIT's mandate, which is delivering more than just the attractive income that you can get from renewable assets, but also delivering additional capital growth. And we do that by investing into projects at a slightly earlier stage than most of the peer group, bringing assets through construction, and even backing the developers who are doing the permitting and design work to get projects to a ready-to-build stage. And those developer investments are particularly interesting because they give us really attractive optionality. So the developers that we back, we have the right to decide which projects coming through that pipeline we might want to build, and so are therefore able to access projects without having to go through competitive auctions, but also have the choice to sell them into the market if we choose. And we do all of this through an impact lens as well. We embed ESG and impact principles right through our process, making sure that we're looking after the communities and the environment around the projects that we build. So that gives us the portfolio where it stands today, as I say, around 800 megawatts of operating capacity, principally onshore wind and solar, but also one offshore wind farm in the North Sea. And those assets are located in Ireland, the UK, France, Germany, and Finland. We have in the past held assets in Poland, Sweden, and some development sites in Spain, but we have successfully exited those all at premiums to the holding value. And this slide shows you that diversification, which is a core part of the strategy coming through. So of the roughly £1 billion gross asset value that we are looking after in ORIT, you can see that we are roughly evenly balanced between wind and solar, alongside the 4% that we have in developers. And if you look at the asset phase, you can see that we are almost fully into operational assets now. And that's something I'm going to talk about quite a bit more because, frankly, it's not where we want to be. And it reflects the fact that the assets that we've been building since IPO are now all successfully delivered through into operations. Before I get onto that, I'll touch on the developer assets that we've got. So we've backed 5 developers across a range of different technologies and countries. two that I want to pick out from this list are Nordic Generation and BLC Energy. So these are both developers focusing on onshore renewables. Nordic Generation are developing solar and wind projects in Finland, and BLC are developing solar projects with co-located battery storage in the UK. And these are both developers where we've committed additional follow-on funding during the course of 2025, reflecting the positive progress that they've had with their pipelines. And there are assets coming through from those developers that we would hope would reach ready-to-build status in 2026. And if you look at that roughly 10 gigawatts of assets being developed, around 2 gigawatts of that are projects that we would hope would reach ready-to-build stage in the period between now and 2030. So I'm going to move on now to something that was announced on Tuesday of this week alongside publishing our interim results, which is really a roadmap for the next 5 years that we're calling ORIT 2030. And this really recognizes that there's significant challenges in the investment trust space at the moment, particularly for renewables. I'll touch on that in a bit more detail in a second. But we think there's also lots of reasons to be positive. And so this 5-year strategy as to how we are going to deliver what we think will be the best outcome for shareholders rests on the 4 pillars shown here: growth, scale, returns, and impact. So taking these in turn, I've shown you just now that we are 96% into operational assets within our portfolio at the moment. And looking forward, we want to get back to that core part of our mandate that we've had since IPO, which is to deliver not just the attractive income from those operational assets, but also the NAV growth that can be delivered through successful deployment into construction and indeed developer opportunities. As we deliver those projects through the life cycle and manage the risks that come with construction, you see a yield compression, and that translates into capital growth. We have also heard a lot from the extensive shareholder consultations we've been doing over the past months that a lot of our investors want to see greater scale in the vehicles in this space. And so we've set an ambition to grow ORIT to be a £1 billion plus company by the end of 2030. We're starting from a point where at the end of June, our net asset value was 540 million. So that is clearly an ambitious target. And we can deliver a significant portion of that through the capital growth that comes from that organic investment activity. But we are fully acknowledging that to get to £1 billion, it will take inorganic activity as well. So we are actively looking at where there are opportunities for activity at the corporate level, consolidation in what is a sector that arguably has more vehicles than it needs. On return, if you look at our IPO return target, that was 7 to 8% in the long term and reflected where the market was at that time, with near zero interest rates and long-term bond yields below 1%. And that translates into what you could have received on the assets at the time. We're now in a very different place, and that return target, frankly, had become stale. And so looking at where assets are valued now and with reincorporating that capital growth element into the return picture, which we simply haven't been able to focus on that much for the last couple of years, we're confident that we can achieve a 9 to 11% total return over the medium to long term from investing without changing the original IPO strategy. And finally, impact will remain core to how we invest. And by that refocus on new construction and development projects, we are delivering ever greater impact through having new projects coming through onto the grid. And that new project pipeline not only is decarbonising the economy, but also with wind and solar being the cheapest form of generation almost anywhere in the world now, potentially supported with battery storage and other similar technologies. Delivering this new generation will also help consumer bills come down in the long run and improves energy security by reducing reliance on imported fossil fuels. Now, I said before that we are not going into this ignoring the challenges that the sector is facing. We are very aware that shareholders have not had the journey that we would like them to have had over the past few years, not just with ORIT, but across the entire renewables sector. Vehicles are trading at deep discounts, 30 to 40%. And that is not what shareholders want. It's not what they should expect. We've also seen that dividend cover has become tighter again across the entire sector. ORIT's dividend for the first half of 2025 was fully covered at 1.19 times, and we're confident that we can keep growing the dividend and keep that covered, but there is less headroom there across the sector than there was. And the focus has had to be on shorter term priorities. So we've been carrying out buybacks, as have most others in the sector. But if you look at the assets that we're holding within these vehicles, they are finite life assets. And so without reinvestment, eventually, even with buybacks leading to NAV accretion, NAV will start to come down as we get nearer to the end of the life of these assets. And then the third thing we've seen is that there's been a lot of consolidation in the investor base and also a lot of outflows from multi-managers. So with that sort of wealth sector consolidation, there's an increasing focus on having larger, more liquid vehicles. But we see reasons to be positive as well. So within Octopus, we manage a number of private funds alongside ORIT, and we continue to see very strong fundraising into that sector. And we continue to see lots of opportunities coming through to invest in attractive assets in a sector that has huge growth ahead of it. And that gives us confidence in our NAVs and also confidence in the returns that we can deliver looking forward. And what we hope to demonstrate to shareholders through the ORIT 2030 strategy is actually that investing into these growth assets, construction and development, can deliver a better long-term NAV per share outcome for investors whilst maintaining acceptable gearing and indeed strengthening dividend cover compared to where short-term focus has been up to date on buybacks. And then scale, we've talked about that scale is attractive to our investor base, and we recognize that that will require inorganic growth, but we see that there are opportunities there to deliver that. So looking in a little bit more detail at the opportunity. So I've said that we see a lot of interesting things coming through that we could invest in at the construction stage. And although you certainly get increasing levels of noise around sort of political sentiment towards net zero, when you look at what's actually going on across our existing and potential target markets, it's not just ambitions, but there are actual auction rounds coming through. So the CFD in the UK, but also a range of different auction mechanisms in countries like France, Germany, and Italy that are going to give contracts to gigawatts and gigawatts. So billions of pounds, euros worth of new investment coming through with projects ready to build over the next couple of years in these target markets. So the opportunity is huge. And the fundamental economics of this being the cheapest form of generation, and the fact that power demand is increasing dramatically as we electrify transport, heating, and indeed with all the new demand from AI and data center growth, means we are going to need a lot more of this generation in order to deliver that in the cheapest way for end consumers. So if I just step back for a minute and sort of try and justify the sort of assertions around investing for growth being the better outcome for shareholders in the long term, we've really got three tools available to us when we're looking at how to deploy capital. We can give it back to shareholders through increasing dividends or buybacks. We can invest for growth, particularly those construction and development assets, or we can look to repay debt. And these graphs here show how we see that flowing into shareholder outcomes over the long term. So what you're looking at here in the dark line is just one scenario that we've modeled. So don't take this as a forecast, but if we invest repeatedly into new construction projects, funded in the near term by recycling capital out of operational projects, clearly in the longer term, we'd hope that equity markets would reopen, but we can't rely on that. By delivering that capital growth from successfully managing construction, NAV per share increases steadily over time. In contrast, if you look at the pink line, what we're showing is let's assume that we do a similar volume as we might invest into construction in 1 year into buybacks. That is where discounts are right now, clearly more accretive on a pound for pound basis, but it's a one-off. You can't keep doing those buybacks again and again and again without stretching gearing to an unacceptable level. So actually, relatively quickly, the investment for growth and recycling scenario overtakes on a NAV per share basis. Luckily, with buybacks, you could just similarly recycle and do another big buyback. But then we've heard from investors they want scale, and all you're doing there is shrinking the vehicle into irrelevance. And actually, you'd be better off going through a managed wind down scenario. But we've seen others in the sector trying to deliver that at the moment, and it's not straightforward to do quickly and in a way that protects shareholder value. So we think investing for growth is the right scenario, the right ambition to deliver the best long-term shareholder outcomes. So how does that sit with what we've already said about 2025? So I've talked about how our return target was out of date, that's 7 to 8%, just hadn't been updated since IPO. And so we'll now be looking at delivering 9 to 11% over the medium to long term. Recently, that will keep the existing level of dividend and grow it from there, but we will be adding on that element of capital growth that comes from refocusing on the construction and development activity. And in 2025, we committed to increasing the share buyback program to 30 million. Around 23 or 24 million of that program has been used to date. That has delivered NAV per share accretion, but it simply hasn't had any meaningful or lasting effect on discount to NAV. And that's true across the entire sector, not just us. And so because of all the reasons I've just gone through, we intend to refocus for the next 5 years on going into construction and development assets as a higher capital allocation priority. One thing that has not changed with the ORIT 2030 strategy is we retain that commitment to bring gearing below 40% of gross asset value. We're currently at about 47%, but we're on track to meet that 40% threshold through asset sales expected to complete towards the end of this year. So looking forward, we will be willing to take gearing above 40% on a temporary basis using short-term facilities in order to access those construction opportunities ahead of recycling, but then recycling to make sure that we anchor long-term gearing below 40% consistently. And the ORIT 2030 clearly delivers that greater impact from the new construction projects. So this slide gives a sense of how the portfolio composition should shift as we implement this strategy. So right now we're about 96% in operations. We intend to bring the construction portion up to around about 20% at any given time. Clearly this will move up and down as projects come through into operations. And we're also retaining the existing 5% limit in our investment policy for developers. And in terms of technology, again, we don't expect to see dramatic changes here. We have always had a focus on being diversified between wind and solar. And our approach to diversification is becoming ever more data-led, looking at where putting different technologies together in the portfolio can offer the greatest dampening of volatility through having anti-correlated cash flows. One area that we do see an opportunity to increase exposure from the close to zero that we have at the moment is battery storage. Particularly if you look at the projects being developed at the moment, pretty much any solar project that's being pursued by our developers will have space for co-located batteries as part of its planning. And we do see for a lot of assets having weather variable generation and storage together in the same market is likely to provide some natural hedges within the portfolio that we think means it's a sensible thing to add in. But we will maintain that limit for non-wind and solar technologies in our portfolio of 20% of gross asset value. So to sum up before questions, we are very mindful that shareholder experience over the past 2 or 3 years has not been nice. No, it's not been what we would hope for. But we remain confident in the quality of the assets and that our assets are fairly marked. We do not see that discount to NAV as reflecting anything close to the reality of what these assets are worth. And with the platform that we've built, with the high level of fixed cash flows that we have in that operating platform, we're confident that we can deliver this refocus into more growth investment whilst continuing to maintain the existing level of dividend that we have and grow it from here and keep that dividend covered, but effectively add on top of that the element of capital growth that we've not been able to focus on in the last couple of years. And all of this while delivering the higher impact that comes with construction and development projects. So that's that for my presentation. And yeah, interested to hear any questions that people have.
Brilliant. Thank you very much, David. Very interesting. And there's almost sort of two halves to this, I think. So what we'll do, I think, is we'll do the sort of little picture things first, sort of the questions around individual assets and results and things. Can you explain why you exited Spain to start off with, please?
Yes, there's sort of two bits to that. There's the sort of assets and opportunity specific bit and then the broader market bit. So we had back in, I think it was 2020, entered into a transaction where we had the right to build some projects in Spain when they came through to ready to build. I think it's fair to say it took the developer longer than expected to get them to that ready to build stage. And by the time that happened, we were into the post mini budget period, and the ability for us to fund those projects would have required, we weren't going to be able to issue equity to do it. We would have had to have bought in more debt. And the returns available on those projects would not have justified pushing gearing to the level it would have taken to actually take them forward. Alongside that, the sort of commercial leverage that we'd managed to get in as part of the initial deal meant that we were able effectively to get the developer to buy them back for us, buy those rights off us at a profit. So we recognized a gain on the sort of the amount we had committed, and we're able to get out of that without having to stretch gearing. I think one of the more sort of market-based reasons as to why the returns didn't make sense to us at that time compared with what the developer might have been able to achieve selling it to someone else and therefore were willing to sort of buy us out is around that time in say sort of 2023, early 2023, I think it was, there was quite a divergence in the range of forecasts for long-term solar captured power prices amongst different advisors in the market. And we were very much at the conservative end of which advisors we were choosing at that point. And there were other people out there buying on what must have been much more ambitious forecasts. And so with our revenue assumptions, the projects just didn't deliver a high enough return. What we've seen happen since in the Spanish market is the amount of money that a developer can achieve by selling a ready-to-build project has come down a lot because everyone's power price forecasts, particularly in the medium to long term, have come down. So I think even the ones we had have come down, but the ones that were much higher have sort of come down further and faster. So the speed at which solar has been built in Spain and what that's done for the price of the power you can sell in the middle of the day in summer in particular has meant those projects are just less valuable than people assumed.
Okay, that would make sense. Thank you. Maybe it's to sort of illustrate how things work. Can you talk us through the Irish Town Solar project? Because it's something that you ran relatively recently. Without to you have to get exact numbers, but just sort of give us a ballpark as to how the whole thing works, please.
Yeah, so the Irish Town project is going to be a sixth site being built nearby to the 5 sites we already have in Ireland, just north of Dublin. And the way the sort of transaction structure has worked on those investments is that we're effectively agreeing a price for what we will buy the asset for when it is built. So no, we do like to be involved in the construction of projects and to be able to sort of capture some of the gains that come there. But this particular transaction and the previous ones in Ireland have not been like that, just down to what the developer was willing to do. So effectively, the developer is taking the cost and time risk on construction, and then we are buying for a fixed price once it's operational. On Irish Town, that's expected to be in the second half of next year. What was quite unique about Irish Town is that for it to connect to the grid in Ireland, it needs to use some of the infrastructure that is controlled by one of our existing sites. And that means that for the developer to have sold to anyone other than us, they would have needed to have found a much longer and more expensive route to connect to the grid. And that means we've been able to sort of get economics on Irish Town that are better than we would normally expect for an operational asset. So it's sort of consistent with our focus on sort of higher returning opportunities than we might get from buying operational assets typically, because of the unique circumstances of this site.
Yeah, thank you very much. And there's a question here about Woburn Road Battery. There's something that I haven't seen, but maybe I've missed it. Is there a
No,
story
that's
around that?
fair. Yeah, so I didn't focus it as we went through. It is sort of covered in the interim report, but we have had for some time a very small battery. So it's one that we only had 50% of it. So that is a transaction, again, dates back to 2022. And because of the market situation in 2022, once that project started building, we actually agreed a deal with our co-investor that they would fund the construction and we would have an option to catch up or not up until the time the project was built. And obviously, if we had caught up, they would have had they would have kept the construction gain. When it came to earlier this year and the project was up and running, and we looked at the economics, it just wasn't good enough for us to take up that option. So he said, no thanks, you can keep all of it. And so yeah, that's not part of our portfolio. That doesn't mean that we're not interested in batteries. It's just that particular asset, I think, particularly given the size of it and what had sort of changed in the market between 2022 and now, it simply wasn't one that we needed to do.
Thank you very much. Right, now sort of bigger picture things. So let's talk about dividends first. So I think that's a big chunk of reason why people bought these funds. But obviously part of what you're trying to do as well is grow the NAV, so grow the total return. It's not just the dividend. But within this, your sort of vision for 2030, do you see a progressive dividend going all the way through to that?
Yeah, absolutely. So we are not moving away from that existing progressive dividend policy. I think one important point to pull out is we have always had a progressive dividend policy. In the last 4 years, we have grown the dividend in line with CPI, but that's always been a sort of year-on-year choice. There's never been any formal inflation linkage in the policy. I think with the ORIT 2030 strategy, it's important that if any investor is sat there sort of anchored to an assumption that ORIT will always grow in line with CPI in terms of the dividend, they shouldn't have that as a firm expectation. We do expect to grow the dividend year on year, but it will not necessarily be linked to inflation. And our scenario analysis shows that because of the new cash flows that have come through from the construction assets that we're delivering and those newer assets, one, we can keep growing the dividend from where it is now. So there's no sort of suggestion of a cut as part of this refocus on growth. sticking with what we've got for 2025 and then intending to grow it year on year from there. And the intention is that it will remain fully covered. But not only that, is when you sort of, we went through that in a bit more detail than we've got time for today, but I think the slides are on our website from our capital markets event earlier in the week. If you look out a bit further and look out into the sort of early to mid 2030s, when some of the older subsidized assets come off their subsidies, we think our strategy actually makes the dividend growth more resilient over that sort of 8 to 10 year time horizon than the alternative, because those projects are going to see quite a dramatic reduction in their revenue. They will also have seen a lot of their debt service paid off, so there are offsetting things, but our scenario analysis shows that actually with this strategy, dividend cover looks stronger in the mid 2030s than it would have done if we'd have just effectively sat on the existing assets. And in the time, over the next 5 years, it's also, a growing dividend and maintaining,
Yeah, okay, that all makes sense. Thank you. I think it's important to explain to people that this sort of ending of revenue, wind subsidies and that sort of thing, it's all baked into the NAVs already. It's not something that's going to come as a surprise down the line. Yeah. Cool. So, big picture then, that ideally you'd like to be able to take something over. Do you have an idea for what sort of thing you'd like to do? I mean, there are a lot of cheap assets out there, just listed as well. Is it just a sort of like a friendly merger type deal, or do you think you could end up doing something more aggressive?
So, yeah, so I think if you look at what's on our minds when we talk about that sort of inorganic element to the scale ambition, in order to deliver that, we want to be using ORIT shares as currency, not cash. If we're using cash, it's not actually scaling the vehicle, it's just stretching gearing. And the most obvious place where there is a sort of established route to how you do that is in the investment trust worlds. That remains the most obvious route to that inorganic growth, is consolidation within the sort of renewables and nearby adjacent investment trust sector. We're not pretending that that's straightforward, because we are on as deep a discount as the peers. So there's no obvious sort of arbitrage there that makes that easy. But if you listen, and we spend a lot of time talking to our larger shareholders and try and give opportunities for everyone to communicate their views as well, investors are rightly fed up with how the world's been for the last couple of years. And so it's very hard to imagine that over not even a 5-year period, but 2 or 3 years, if not less, that the status quo can remain. There have been a few exits starting to come through, but there are still quite a lot of vehicles in the sector, all of which are trading on deep discount. So something has to change. And I suppose the other piece to it is we see that ability to deliver growth and to refresh the asset base is really important for the long-term viability of this sector. And within ORIT, we have already overseen the construction of 500 megawatts of new construction capacity. Within our broader sort of fund stable at Octopus, we've delivered somewhere between 2 and 3 gigawatts of new construction over the past sort of 15 years or so. So we think we're very well placed to be able to deliver a resilient strategy for the future. And so hopefully can be a consolidator. I think, again, we're not pretending it's going to be straightforward or happen overnight. And the other piece is we will have to be very clear with investors as these kind of opportunities come through what our plan is. Because if you look across the universe, there's not many vehicles that you could just put together with ORIT without shifting our diversification around away from where we'd like to be. But again, we've shown in the past that we can sell assets well. We should have more evidence by the end of the year of that as well. And so we think investors should be willing to consider mergers that maybe leave us a bit overweight one country or one technology, provided we can communicate clearly how we're going to bring that back into balance quickly. And I think finally on that, we are sat with private funds as well. So there may be opportunities to have joint processes where there is cash if there are assets that our private fund would like, that would also help the diversification. But this is all going to be needing a lot of work and probably more failures than successes along the way. But there's enough out there and enough investor demand for it that we think it's deliverable as part of this 5-year roadmap.
Brilliant, thank you. This recycling the capital thing is a theme that I keep hanging on about, that seems to be really slow progress in the sector. You do have these mature assets with very predictable cash flows, especially with the subsidy side of things. They ought to be snapped up by pension funds and the like. Why isn't this happening already?
It's a good challenge, and no, we have delivered asset sales, but it is harder to sell into the current market than it was a couple of years back. I think part of that is that a lot of, particularly for UK assets, the investment trusts were just a big part of the buying universe. Yes, we do manage money for some pension funds that hold assets like this, but some of those pension funds used to hold these assets as a bit of effectively a bond proxy, and they can hold bonds now and earn a return. That sort of pressure is less than it used to be to find return. And I think as well, an increasing number of pension funds are looking, particularly the sort of older defined benefit pension funds, are looking at making their asset base look really easy and homogenous for a buyout or a risk transfer as they sort of reach the end of their life. So we do still see a lot of demand for assets of this type, but I think return expectations have moved up. Some of the bidders have sort of left the UK market. We're still seeing maybe some Far Eastern buyers who are interested in the assets. We are still seeing pension funds who are interested in the assets, but there aren't as many people out there who are willing to accept a sort of 7 to 8% return on operational assets. They need that little bit extra, and so that's why particularly the UK asset sales are not coming through as quickly as some might have liked.
Okay, fair enough. Thank you. You've mentioned in that presentation about the gearing level, and maybe taking it up briefly if you can find a way of bringing it back down again. What is a sensible level of gearing, do you think, for this portfolio?
Sorry, I might have nudged your slides there.
That's all right. Doesn't hurt to have that out when people need to read it.
So yeah, I think there's two bits to that. So if we held the portfolio we have within ORIT in a private fund where the investors were pure sort of IRR driven investors, the level of fixed cash flows that we have means that we could have significantly more gearing than we do. These are assets with contracted revenues going out quite a long way, and it would not be unusual to see 60% gearing on assets like that. But that would not be consistent with paying out a significant component of the return as income and maintaining that as covered. So that's why our sort of long-term policy limit is 40%, is it reflects partly just the investor base and their particular sentiment around gearing, but also the fundamentals of how we're paying out that return. If you want covered income, you can't have quite as much gearing unless you take on a lot of refinancing risk by having purely non-amortizing debt. And so, that's why we say anchor below 40. But because we're confident in our ability to recycle, provided that your short-term debt is not so short-term that it matures before a realistic sort of recycling timeline, bearing in mind that, yes, sales processes can take 12 to 18 months. So you've got to keep an eye on the maturity of your short-term debt. But we think the asset quality allows us to have that flexibility to move temporarily above 40 and then bring it down. The right level, that will evolve again depending on the revenue mix. So if I look forward 5, 6, 7 years, we will need, and again, we have a track record of doing this with corporate PPAs, but we will need to keep adding contracted revenues going further out in order to maintain the same level of gearing. But we've done that on 2 of our wind farms, 1 of our solar farms, actually 3 of our wind farms. So yeah, we've got a good track record of putting those longer term contracts in place.
If you think about, I suppose you've got a much broader use case because a lot of these things are just UK and you're Europe. Is there a sense that can you give us an idea of how much more renewable energy and storage and stuff is needed to stick on those grids, please?
So a lot is the short answer, but for certain technologies, potentially not as much as is already in the pipeline. I had a slide actually with some of the sort of ambitions for the UK. I might be able to find that one again. I'm just messing up the system, but sorry, sneak preview there. So yeah, so these numbers here, 30 gigawatts more solar by 2030 in the UK. That is a huge amount compared with, I've lost track exactly where the numbers are today, but it's not as much as that, I don't think. 13 gigawatts of onshore wind, that's not a doubling necessarily, but it's a lot more. So there's a lot more that's needed, even if sort of political ambition for particular target dates gets shifted. Just the sort of the economic necessity and the shift, just because they're better. Again, so the shift to electric cars and things like that, even if targets are changed there, they are just better. And we do see this sort of shift to an electrified economy happening, sort of irrespective of sort of political dynamics. So there's a huge amount that's needed. There've definitely been times. So if you look at, for example, the number of battery projects in the queue for a grid connection in the sort of GB system, there's a lot of stuff in there that will probably never happen. And the system is going through a process now of sort of chopping out dead wood from that grid queue. So I think when we're looking at our developer investments, we have to be very, very sort of careful to make sure that we are targeting the right sort of projects in the right places where we can be one of the ones that is needed. But for the sort of construction side of things, the things that are going to be built now over the next few years are absolutely things that are needed. And then as you get a bit further out, we are still going to need all of that generation. And you've got projects that are going to start coming towards the end of their lives that need repowering. And some of the work, again, we had some slides on this in our sort of bigger deck as part of the capital markets event, that actually it may make sense economically and for the sort of broader system efficiency to start repowering some of those sites when they come off subsidies at the end of 20 years rather than waiting for 30 or 40 years. And none of that's in our NAVs at the moment, but if it does make sense, we'd expect it to be NAV accretive. So it's something we're already starting to do work on, is looking at where, if certain markets are looking a little bit saturated by the early 20s, which is an if, there's still that value add that we can deliver through repowering, through hybridization, and other sort of enhancements. I'm not expecting in my career to get to a point where there isn't a huge pipeline of new projects of this type that need funding.
Brilliant. Thank you very much. That's a good place to end up on, I think. Really good. Very interesting. And it's good to sort of think about the kind of long-term future of this, because people get fixated on the short-term stuff. Is the very important disclaimer slide again. So make sure people see that. But thank you for your time today. We will be back next week. And we have only a few more days left to vote in our Investors' Choice Awards. Closes, I think, on Tuesday next week, so 30th September. So if you haven't voted, please do so. Have a good weekend. Thank you again, David. And we'll see you next week.